Okay, why are my property taxes so high? This can't be right. This is not what I thought I was paying. Who do I call?
And this is the phone call that no real estate agent wants to receive after closing, but it happens. Today, we're solving the why behind this and how to prevent it. Welcome to Recharge, real strategies, real stories, real estate. And today we are talking Michigan property taxes. I am Ashley Dane, joined by my co-host Kaylee Wilkinson. We'll be breaking down what these tax terms mean, some unexpected surprises, and how the best agents in the business prevent homeowners from getting blindsided. Now, just quick, tiny little disclaimer. Of course, today's podcast is educational and should not be constituted as any type of legal or tax advice for your specific situation. Please always consult your local assessor or qualified professional.
And today we have the pleasure of speaking with Molly Whetstone, a leading expert on this topic and who has been assessing Michigan properties for over 35 years. She served in equalization leadership, even serving as president of the Michigan Equalization Directors Association, and is co-founder of Great Lakes Assessing. So Molly, welcome to our podcast here.
It's a pleasure to be here.
Yeah. So before we get into the bill itself, what is your background? How did you become a tax assessor?
Nobody wakes up in the morning and says, I want to be a tax assessor, right?
Right.
I was working at the Wexford County Clerk's office, and a position had been opened up in the equalization department below, and I always loved to learn, always loved things. Mm-hmm. I applied and got the position as the staff appraiser. I was the first female staff appraiser for the county. So
amazing.
I loved it.
And that was 35 years ago?
Yes.
Okay.
35 years ago.
Wow.
Lots have changed.
I bet.
In 35 years.
Yeah.
So,
and we'll go over that today, I'm sure.
Yes, we surely will.
What do most agents and homeowners misunderstand about your job and your profession?
That I can set my assessment at 50% of their sale price. It's illegal in the state of Michigan to follow sales. So if I could do my assessment roll at 50% of what everything sold for, that would be much easier. But we can.
Yeah.
And that everything, when I do my assessment rolls and set my assessments, I am working on data. The state of Michigan requires a 2-year sales study. This year it was from April 1st, 2023 to March 31st, 2025. And those are the numbers I had to use for my 26 assessment roll. So I'm a little behind the times when I set my values.
Yeah.
And people think I'm a fee appraiser and it should be right where they paid for it. But I'm 18 months behind.
Oh. And I imagine when people call your office, it can often be a stressful situation or conversation. What do you wish they knew before they dialed?
I wish they had a real estate agent sit down with them and say, I am not concerned by making a sale. I'm concerned if you can afford your house. This taxable value has not been uncapped in 30 years. It is going to go up to $150,000 from $50,000. Your taxes will triple. Can you afford this?
Yeah.
And that agent may not sell them a house today, but they will tell all their friends and family what an awesome job they did because they actually helped me figure out what I could afford.
And there's no surprises when they get to a conversation about this. And it's like, what? I'm here to sign my mortgage. Like, why are we talking about this now? Let's have this conversation.
You need the conversation ahead of time.
Yeah, right. So what's one thing about your work that would surprise people?
That I pay taxes myself.
I love that.
Even you can't get out of it, right?
I have to pay taxes, and that I am bound by the rules of the State Tax Commission. So they give me a set of rules that I have to use, and whether I have to use those rules, and that that's how we derive at our assessed value.
What are the most common assumption traps that you see where people think that they understand the property tax situation, but they really don't?
Big example that I dealt with recently was somebody bought a house on Lake Michigan, because I deal with Lake Michigan. It had been in a home for a long time. The realtor said, this is what your taxes are going to be. Uncapped on Lake Michigan, and not only did it uncap, but it's their second home. So they had an increased tax bill that was a lot of money.
When we say a lot, what does a lot mean?
Probably $20,000.
That qualifies.
Yeah.
Every
Because you
year.
lost the 18 mills and you uncapped.
Phew.
So they did not have any understanding of Michigan tax law.
And this is why we're here. We hope
Correct.
we can help get this information out to our RE/MAX agents and beyond. Now, Michigan's property tax system can be predictable for long-time owners until a transfer happens. So Michigan has this phrase, you've mentioned it many times, many people have heard it, but they may not know what it means, capped taxes. This all ties back to legislation from 1994. Can you walk us through that history? What changed in 1994
Sure.
with Proposal A? What is Proposal A?
Well, in 1994, we the people, for the people, by the people, voted in to change how we fund schools. So at that point in time, we gave ourselves the 6 mil education tax, where everybody in the state pays 6 mils, it goes to the state. We pay the 18 mils for non-homestead, commercial, and industrial property. Okay. And there are 2 other classes, that developmental and timber cutover, but I have none of those in any of my jurisdictions, so they're not relative to me today. They changed all of that, and then we gave ourselves the sin tax on cigarettes. We gave ourselves a cut in state income tax, what was it, 4.6 to 4.4%. And we raised the transfer tax when you buy a house.
That was a big bill.
That's a big bill. So it changed lots of things when we voted it in. And one of the big things it did is it reduced the bills, some of them up to 40%, because you no longer had the school operating we were paying, which you had before, because you paid whatever the voters voted in on your SEV. So this bill created the old traditional system of state equalized value, assessed value is still in operation. And then we created the taxable value, which is the marvelous thing. So the taxable value is a mathematical calculation. It is prior year's taxable value minus losses times the inflation rate multiplier plus any additions.
They couldn't make that more complicated if they tried.
You're right. They couldn't have. And there's lots of little hidden things within there if your house burns down and different things that the assessor has to calculate. We now have 2 systems that run side by side. The assessed system that's always been there since 1869 and the taxable value system. So they're 2 systems that just march along side by side, and the taxable value has nothing to do with the assessment cycle.
And that's where the wheels fall off the bus for most of this.
That is right.
And we will get into that in just a bit. But what would you say the good was with Proposal A? And also, what's the bad?
30 years into Proposal A, I'm not sure that I can tell you any good, because what the people had 30 years ago with the reduced millages, we've all voted extra millages in. So we have no reduction in what we're paying in millages if you're a non-homestead.
Mm-hmm.
And the good is that if you're like me and you've owned your house forever, I have a much less taxable value.
Yeah.
But yeah, we need to, at this point in time, the bad is that young couples
Mm-hmm.
struggle. Their taxes when they uncap can be more than what their house payment is.
Mm-hmm.
So that is the bad side. I would have loved to have bought a new house, but I looked at low taxable value, uncapping, and said, mine's just good.
Yeah. And that opens a whole can of worms as to like economy and why we are where we are, but we won't go into all those logistics today. But to be honest, I was barely in kindergarten when all of this went down, right? And now that I've been a homeowner for a decade now, I'm still not sure I fully understand it. Can you help break it down for our audience? Like, if my home value jumps, does my tax bill automatically jump the same amount?
No. If your home value goes up, that's all market driven. Okay.
Right.
Your assessed side is market driven. Your taxable value side only goes up by that inflation multiplier if you've done no improvements to your property.
Mm.
Now, an improvement to your property is a garage, a deck, addition.
Mm-hmm.
So when you do that, then yes, your taxable value goes up.
So these are all exterior things in my house.
Right.
Improvements inside, not so much?
I do not look at the interior of homes, because you let me in your house, you don't let me in your house. That's unfair.
True.
So we do the exterior of the home, and you can tell a lot by the exterior, depreciation, class.
Mm-hmm. Mm-hmm.
So unless you have a defect, then I will tell you I am from Missouri, the show me state, and you need to show me.
But we're in Michigan, so we won't have to worry about that right now. Mm-hmm. But if increased value leads to increased taxes, what about decreased value? Homes are selling in my area for less than I paid, right? Shouldn't my taxes go down?
No, because it goes back to what I explained. We have two systems running side by side. And unless your taxable value, your assessed value for this year is less than your taxable value, it will not go down. That is just what we voted in Proposal A. It's a mathematical calculation.
It's locked in that legislation that your property taxes only will ever go up. They cannot go down.
They can go down. If your assessed value drops below your taxable value, then your taxable value will be as the assessed value is.
In what circumstances would your assessed value go down?
If you are really helping your people and you've looked at my assessment card and you go, I see these issues here, you need to go to Board of Review, okay? So the year after you buy your house, your assessed value and taxable value become the same thing, okay?
Mm-hmm.
So you come to my March Board of Review and you go, this is wrong, this is wrong, this is wrong on my assessment card, and Board of Review lowers your value, then your taxable value will go down.
But outside of that scenario, your assessed value is not going to just miraculously go down 1 year.
It might. You're smiling at me, but remember 2008 and 2009 when the real estate market crashed?
Mm-hmm.
That is a time where we saw assessed values dropping below taxable values.
Mm-hmm.
But since that time, it's not happened. And especially in the market we're in now, I don't foresee that happening.
Right. Yeah, absolutely. So I'm looking at my tax bill and I see words like taxable value, SEV, millage. What am I paying for? Help me.
Taxable
Break it down.
value is when you bought your house 10 years ago, your assessed value and your taxable value became the same the year after a transfer. Okay.
Mm-hmm.
Then your assessed side's just been flying up with the market.
Mm-hmm.
Your taxable value has only gone up by the inflation rate multiplier. So your taxable value is set by law, and it's a mathematical calculation.
Mm.
There's no wiggle room. When we teach classes for Board of Review,
Yeah.
they cannot adjust a taxable value because it's law. It's the law tells us how it's calculated, and that's it.
Mm-hmm.
Your SEV is your state equalized value of your home. So when I'm doing my studies, I come up with the true cash value.
Mm-hmm.
It's divided by 50% because we assess at 50% of true cash value. So that's your state equalized value. Two systems
Mm-hmm.
that have nothing to do with each other. That's so confusing.
Yeah.
Okay, we're gonna peel this back a little bit because I want it to be extra clear for anyone paying attention and listening to this. Let's define some of these big terms. Market value, you've said it a few times. Market-ish value, right? Who determines and how is the market value on your tax bill calculated?
Okay. What determines the market value is what a willing buyer and a willing seller are willing to pay for a home.
Every real estate agent will agree with you on this. Yes.
They will.
Yes.
And in this market-ishy things, because I am 18 months behind in my market,
Mm-hmm.
I am never caught up to my market.
Mm-hmm.
Your market value is determined by the sales within the area. And the equalization department gives me a study that says my residential class is 20% low. That is based on the sales that have sold compared to my assessed value. So when houses are selling for $100,000 more than I have them assessed,
Mm-hmm.
then that creates the increase in the market.
Mm-hmm.
So the market value is based on sales, but it is not recent sales. It's based on an older data set.
Correct.
Okay, this is very helpful. All right, our next one is the SEV. This is state equalized value,
Correct.
right?
And it always should be the same as the assessed value.
Mm-hmm.
And if you have an SEV different than the assessed, then your assessor did not do a very good job, because that means the equalization department had to factor that roll to bring it up to 50% of true cash value,
Okay.
because they did a poor job.
Okay.
You tell them, Molly.
Yeah.
I will.
All right. So the SEV should always be 50% of that market value.
Correct.
Okay. And we're not getting taxed on the SEV.
Correct.
Okay. So now we move into the one that we are, the taxable value. This is the one that drives our bill.
This is the one that drives your bill.
Where is this created?
The taxable value is created through the mathematical calculation that we talked about earlier.
Yes.
And when you purchase your home 10 years ago, you set your taxable value because your assessed value became your taxable value the year after your transfer.
Mhm.
So
Okay.
you
So
created your own taxable value when you bought your house.
all right. So we're gonna make this crystal clear. And I'm gonna make up numbers for easy math purposes. But say a home was purchased 10 years ago for $100,000.
Okay.
And now your taxable value is set. They are the same price or the same rate at that point in time. Year 1, year 2, year 5, your market value has increased by whatever's happening in the market, which in the most recent 5 years has been an awful lot of increase. But your taxable value, because the proposal A is only allowed to go up in small increments
Correct.
based on that calculation.
The inflation rate multiplier.
Mhm. So your market value, if you're a homeowner in 2026 and you bought your home 10 years ago, your market value is going to be significantly higher than what we would say your assessed value, your
Correct.
taxable value.
Correct.
Okay. Oh my gosh, I'm passing this test. I've absorbed this.
You cracked the code,
Yes.
Ashley.
All right. Okay. Now, bonus fun, millages, mills. How are we calculating this?
It's the voted millage, and you pay on $1,000 of your valuation.
So you own a home. It's valued at $100,000.
Correct.
How are we calculating this?
It's 100 times the millage rate, and that's what you're paying.
What do those fund?
They fund everything you voted in. If you voted in senior services, if you voted in extra sheriff's patrol, your township millage, your city millage, it's whatever millages are levied against that parcel. And other than the 18 mills, the 6 mills, the county allocated, all of the rest of those millages are voted in by the people.
So this is all very helpful when dissecting the bill. I'm protected by Proposal A.
Yes.
Market value goes up.
Correct.
SEV goes up.
Yes.
But my taxable value is only allowed to go up with the lower of either 5% or inflation.
It's the inflation rate multiplier or 5%.
Okay.
So we've had 2 years where we had our taxable value go up 5%, but the rate of inflation was 7.3, I believe. And the next time it was 5.2 or 5.3.
Okay.
So we've had 2 times where the 5% has saved us.
Like global inflation or home market value inflation.
Taxable value is based on the inflationary rate that the federal government sets. The state does a 18-month average.
Okay. So after my purchase, market value of my home actually doesn't really play into what I pay at all.
No.
Got it. Okay.
See, this is a fun conversation for us. Right? All right. And if I'm being honest, in our business, we hear war stories about these scenarios in certain circumstances. Why can 2 neighbors have very, very different taxes? And this is all public record, so people see this and it comes up. What are the contributing factors where 2 similar homes right next to each other can have very different tax bills? And when we say different rates, like what are we talking about? A couple $100, couple $1,000?
Depends on when they purchased it. I have some people that have bought a condo and their neighbor has been in the condo for 15 years. They came in and purchased their condo in 25, uncapped in 26. Well, you cannot look at the taxable value because one's capped, one was uncapped. You look at the assessed value. And if you have similar properties, the assessment should be very similar.
The assessment should be, but not necessarily what they're paying.
Correct, because it is how long they've owned their home compared to your uncapping.
Yes. And honestly, if I like a soapbox moment for me, if I could change the world, we all know that I am a real estate data nerd. So a lot of this is we have real estate data, we ship them off to websites, this data gets publicly displayed. For some terrible reason, we have the world's most inaccurate data point that goes out. And that data point is how much does the seller currently pay in taxes? So that is displayed on every website. And what happens here is that a buyer sees that and they're uneducated in Michigan property taxes and they make the assumption that that will be their taxes moving forward. I want to make this data point go away, or we need to have some major disclaimers on it because it's horrifically inaccurate. This is my opinion. How do you feel about that data point being on every real estate listing on every website?
I wish it was not there.
Yes.
I wish that buyers did not know what the sellers actually paid.
How do you fix that? I mean, it's not what the home buyers, the one thing that we know is whatever number is there is not what the new home buyers are going to pay. Do we just remove the data point? Do we add links to the tools where you can figure it out? What do we do?
I would add the link because you're probably not going to get it removed. But I would add the link so that they can go to the state of Michigan's website and calculate what their taxes are going to be.
Yes.
And they need to calculate it at half of their sale price.
Yes. Okay, we'll get there. It's very true that honestly, the worst conversations that we can have in this business is with buyers after they close if they are caught off guard with their new tax rate. Can you identify what are some of the biggest issues for buyers? Is it misunderstanding the concept of capping? Is it misunderstanding the improvements that the tax roll may have had their home in one fashion but the reality is it's perhaps been improved upon since that tax roll had that recorded. Is it believing the data points that are in these real estate listings? What's causing this issue?
I do not know. If I knew, I would fix it. But I can assume that they're looking at that data point and they're basing everything they can do on that data point. They do not have a realtor setting them down going, you are looking at $500,000 houses that will generate a tax bill of $25,000 a year. Can you do a mortgage, live, and pay your taxes?
This is why the trusted professionals that are educated on this become vital in a successful real estate transaction.
They do, because we always, when we get these calls, send them back to their agent. That is just what we do.
But to be fair, these people are acting on information publicly displayed, just like Ashley had just explained, on a listing that they otherwise believe to be very accurate. And I think you've touched on this, but I'm just going to lay it out. What are the most common causes of significant increases in the assumed tax rate?
It would be coming from a homestead to a non-homestead and uncapping.
Okay, what is homestead to non-homestead?
Homestead, if you look at your tax bill and it says school operating exempt, you're exempt from 18 mills. That goes to the state. If it's your second home, you look at that and it says, doesn't say exempt, and you pay 18 mills. That's significant.
So homestead, this is your primary residence, non-homestead, second residence, or
right.
whatever it may
And
be.
that is one of the things that is really misunderstood, is what is the purpose of the purchase? Is it the purpose to live in it, or is it a second home?
Yeah.
Because that truly impacts your millage rates greatly.
I remember when we moved into our recent home, we had not sold our first home yet. Like, it was in the process, right? And so when we got that tax bill, they had us at the non-homestead rate. And my husband and I looked at each other like, what?
Terror.
Yeah. And so we had to go through the process of approving, like, this
Right.
is still in process. And so that, I feel that.
The state has made many improvements on correcting them, though.
Yeah.
Because before, if we had to correct a homestead, it had to go to July and December and Board of Review. And now they've created a form. I just fill it out, send it to everyone, and they don't have to wait to get their money back.
So this is great, because this is where well-educated real estate agents can actually step up and help out. I've talked to many real estate agents about this, many brands, many different experience levels, and it's really surprising to me the variety of answers I get. There are some new agents that come into the business that don't even know that they can call the assessor's office and talk to you about what the property taxes might be after a new home purchase that they're helping a buyer with. On the other hand, I have talked to agents that told me that they call the assessor's office on every single showing that they do for a buyer. So from an assessor's perspective, what's reasonable for real estate agents to ask for in requesting help in understanding property taxes?
That's a tough one. Our philosophy in our company is, if that realtor is calling me for every showing, I'm going to help them any way I can, because then they have an understanding of the property, the house, and the tax structure for that buyer. And then we do not have angry phone calls.
I love that answer.
So,
Yes.
A great answer. If an agent calls before close to help a buyer estimate what their property taxes would be, what's the best way to ask? And this is silly, but should it be a phone call? Is it an email address? And what's reasonable turnaround time for assessors to provide this information?
I can only speak on our company. Our goal is to try to respond within 24 hours. I mean, that's our goal. That's what we expect our people to do. I would always tell a real estate agent to do half of their purchase price.
Mm-hmm.
I probably will never reach it on my assessment cycle, but that taxpayer has to know if it's been uncapped in recent years, this is what they're going to pay.
Mm-hmm.
And I will always help them with the millage rates, but they can also go to Treasury's website and put that in.
I love it. We want to ensure that every single one of our RE/MAX agents are handling this at the highest level of the industry. So for best practices, in your perspective, what are the top 2 to 3 things that agents can do to prevent that panic call after the close?
Number 1, sit down with your prospective buyer and make sure they're not getting in over their head on the home with the taxes. Make sure that you as an agent understand whether this is going to be a primary residence, secondary residence, tax structure changes then. And that's it.
Research.
Yeah.
Well, research.
Yes.
They need to research, but they should have already done that.
Yeah. Yes. And our RE/MAX agents will. All right. So must mention tools here. There is a state of Michigan property tax estimator. Can you explain what this tool is and where people can find it?
Well, it's on the Department of Treasury's website, and it's called Property Tax Estimator. And if you put in, if you're looking at a new home, it has the millage rates in for homestead, non-homestead, your local jurisdiction. You plug that in and you put in half of your sale price, and it will tell you what your taxes are going to be. And it's very accurate.
I love it. There's also another tool that I was tapping for this podcast. It was the Michigan Guidance of Changes in Ownership and Uncapping as a great resource for understanding this process a little bit more. So if anybody wants legalese on how this works, it was a great resource. But on the property tax estimator tool, honestly, like dorky moment here, I love this tool. It's a game for me to a certain extent. When my tax bill comes and my stomach turns at the number that I'm about to pay, I go to this website and I put in my house information as if I were buying my house today in 2026. Correct. And I look to see what the poor soul would be paying if they bought my house today.
Correct.
And I look at the difference and I call that my longtime resident loyalty discount.
I would agree.
The price I pay is painful, but the price I would pay is much worse. So
yeah, that's true.
When I hear people like lamenting over their tax bill, I love to send people there because it's always fun data to see.
It's a sick game that you play,
I
but I'm here
know.
for it.
Yes.
Okay, so I just moved in and I got my first tax bill. What if I actually think it's wrong? Like, do I just have to accept it or what do I do?
Yes, you have to accept it unless it's a PRE issue.
What's PRE?
Principal residence exemption. If you don't have your 18 mil exemption, come in. But there's only certain times of the year the assessor can March Board of Review. The Board of Review can change your value if you think it's not right. And December and July Board of Reviews are for clerical errors, mutual mistake of facts, poverties, and just housekeeping things.
Right.
So, but always go to your assessor and have them explain it to you. They will say, this is what you bought it for. This is what I uncapped it for. Look, I am under what you paid for it.
Yeah.
And look at your record card. You should always look at the record card before you buy a house.
So walk the escalation ladder with me here. You had mentioned the local Board of Review.
That's where you start in March. You have to, if you're a homeowner, you have to appear before the March Board of Review before you can go to the tax tribunal.
Okay.
And come into the Board of Review. They're your neighbors. If you've just bought a house, come into the Board of Review. Look at your record card. Make sure all your information is accurate. And if by some chance you paid less for your home than what it's assessed for, then you can have a discussion and then they will look at your property. I'm a mass appraiser. I do my statistical analysis for Ashley. Then I apply that across everything within that district.
Okay.
So, but my Board of Review looks at the individual house.
Okay.
So always you have to go to your board of review.
Okay.
They're a great group of people.
So that's the first step.
That's the most important step.
And then talk to me about Michigan Tax Tribunal.
Okay, if you're not happy with your board of review, we send you a notice and they go, I don't like this. Then you file a petition to the Michigan Tax Tribunal.
Mm-hmm.
And it is an administrative law judge through LARA. And they will hold a hearing where I present my data, you present your data, and then they make an independent decision on what your property is worth.
Okay. And so is that the actual purpose of the Michigan Tax Tribunal?
Correct.
Those are the issues that belong there?
Correct. It's a valuation issue. If you're not happy with your board of review, then you go to the Michigan Tax Tribunal.
Okay.
That is the next place to fix it.
Okay. So how should homeowners approach an appeal so that they don't waste their time or make it worse?
Just come in and be nice.
Yeah.
Step one.
Right. Step one, be nice.
Mhm.
Step two, the board of review. I always tell new homeowners that this is your time that's setting your taxable value.
Mm-hmm.
You need to come to board of review. You need to look over your record card
Mm-hmm.
and talk to the board.
It doesn't hurt.
No,
Right.
no.
Okay. So what types of cases and scenarios do you see resulting in adjustments?
You come to the board of review. I do not go inside houses. Okay. So when I'm talking to people and they're going, you're really off, I say, come to board of review, but bring pictures.
Okay.
You have to show them, give them something to work with. So they come in, they have all of the pictures, and board goes, wow, Molly, you really messed that one up. I go, yes, I did. And then they correct it
Yeah.
because it's their assessment role at that time.
Okay. So do you have any feedback on what people should not do other than be mean, right? Always be kind. What should agents not promise clients about appeals? So what are the red flags?
That I'm going to set it at 50% of their sale price. Because legally I can't follow sales.
Do you have any horror stories? Like I'm sure you've seen it all. You've dealt with it all. You've been here for 35 years, for goodness sakes. Like, were buyers who were grossly underestimating their future costs part of that? What stories can you share?
I just have people that they buy their dream second home.
Yeah.
And grandma owned it, family selling it, and you're looking at $100,000
Mm-hmm.
assessed.
Mm-hmm.
Okay. Increase from taxable to where it's going to be the year after it uncaps.
Mm-hmm.
And then they lose their homestead. So you have $18,000 on that right at the get-go by losing the homestead without the increase on the other millages. And then their escrow takes them 18 months to be caught up with. And then they're looking at their payment going up. Outrageous.
That's got to be so frustrating and a tough spot for you to be in too, I'm sure. But it is what it is.
I send them back to their agent.
Yeah.
I mean, it's worse for the homeowners.
It is.
Yeah.
I attempt to help. I explain everything to them. And then I go, did not your agent explain this to you?
So, I mean, when you receive these from homeowners and you've been through these stories, what do you wish they'd done earlier? Just have an open conversation with their agent or done their due diligence
they'd have
themselves?
called me.
Mm-hmm.
Yeah.
Because I had an agent. I had a lady from Colorado, which has a very different tax structure than Michigan.
Mm-hmm.
And I spent hours with her on the phone. She was a nice lady, appreciative of my time.
She was kind.
She was kind.
Yeah.
And we went through all the houses in our units that we do that she was looking at. And I gave her the uncapped, what I thought it would be if it was a homestead to a non-homestead.
Mm-hmm.
And she actually calculated the total cost of everything and said, I cannot move to Michigan. So she called her agent and said, I'm not moving to Michigan. The agent called and yelled at me because I cost her commission.
And I think that's the frustrating thing about taxes, at least from my personal standpoint, is I didn't know anything about taxes in high school. It was not an education point. Maybe it is now, maybe it's not. All through college. Unless I was an accounting major, I didn't forget about it. I know that it exists and we need to pay them, and you got to pay them or you go to jail. Like, I get those basic things, right? But like, to be able to have these open conversations to a broader audience, I think will be very helpful in understanding, like, this is what taxes do. This is why we pay them. This is where they apply. Like, it's not just an income tax. Like, there's other taxes out there and we need to be educated on it. So,
correct.
Yeah.
Okay. So, a hot question. Escrowing, good or evil?
Evil.
Why do you say so?
I just have too many phone calls where people are caught. They don't understand that the escrows are based on the previous owner's taxable value, and that when they uncap, it could double, and then it takes the escrow company 18 months to catch up with them. And then they're in a wide world of hurt because they had purchased a home that they were marginal to begin with.
And that's a real thing, because for buyers, they're looking at what their monthly payment will be. And when they look at the closing documents, they are believing this to be what their final number is.
Correct.
And then a year after owning their home, they get the confirmation from the mortgage company, oh, by the way,
we made a mistake.
And actually, this happened to me in my own personal life. My husband and I were building a home. We were working through getting our mortgage all squared away, and our loan officer was having me communicate with the staff and the team. They told me, this will be your tax bill. Well, okay, I have a personal relationship with you. I called you up. You estimated our taxes, and the number that you came back of what we would ultimately end up paying when we moved in was significantly higher than what the mortgage officer was telling me. So I called him up and I said, hey, can we check your data here? Because I understand that this is probably going to be significantly higher. And he stuck to his guns, that his numbers and his calculations were right. Well, with good foresight and a lot of experience in this property tax world, I believed your numbers. And so we put money aside ourselves based on what your numbers would be of what we thought our taxes would be. When it came out, wouldn't you believe it? You were correct. And our mortgage team was very, very incorrect. And they told us, like, oh, so sorry. We underestimated what your property taxes will be. So we're going to have to change your mortgage payment to this, because we have to recapture all of the taxes that we didn't collect from you last year. We have to increase to cover what we need to cover moving forward. Here is going to be your new mortgage payment. Oh man, I was hot, right? But I also was prepared because I was educated, and I was like, no, thank you, sir. Here is a check for the cash for that balance, and we're going to stop the escrow, of which they then charged me $600 for the privilege of not holding the escrow. Oh man, I'm in the industry, and I was hot, but also educated and protected. It can be a trap, and knowing and educating your buyer can save relationships, save people's ability for affordability of their homes and their broader lives that they're paying for. And anyway,
so would you recommend that mortgage company to anybody?
I do, because I like them, but I took the time to educate that team of like, do you remember that email where I sent you, because everything in writing, like, do you remember when I said that I believed it would be this? This is what the number was. And this is why this matters, because you're the larger implications for what people can afford and what that extra money in their lives does.
In your personal experience, though, like with her story, would you suggest that mortgage company again, giving them a bone into the education world? Or would you say, oh, no, they don't know what they're talking about. Move on. You're allowed. I asked the question.
I would probably do Ashley's route. I would probably give them the 24-hour rule where I don't say anything, don't do anything.
Yeah.
And then I think about it and dwell on it. And that's my partner's rule. So my partner's my sister. So, but I would probably educate them. But there are just some places that I would not recommend people go to.
Yeah, that's fair.
Because I just see people all the time. And these people are devastated. They literally they don't have $500 extra a month.
Right.
It's real. Okay. On a philosophical note, I'm honestly curious. We're all working with these rules and regulations that were set in 1994. From your perspective, is our current structure problematic?
Yes. And Lansing is working on this, so
that's great.
We'll wait and see where it ends up. But after 30 years, the assessed side to the taxable value side from people like me who've owned my home pre-Proposal A is a lot of money. And young couples who would be the people to buy my house would struggle to make that happen.
You said earlier in the podcast, and it was just striking to me, that there are circumstances and situations where people will pay more annually with their property taxes than they do on their actual mortgage payment. That's when we talk about affordability, and that's been one of our common themes across many of our podcasts, is the concern about affordability of being able to purchase a home and be a homeowner in the state of Michigan. Are the people in Lansing paying attention to this?
Well, it's an election year. We got Proposal A as a lame duck session. The voters passed it in November. The legislation was written and signed by Governor Engler before he was done. So, you never know what they're going to do, but they are talking about it. It is an issue that they need to do.
I know I don't want my longtime resident loyalty discount to go away, but I also want new homeowners to be able to afford to own a home.
Correct.
It's a tough one.
Tough one. It is a very philosophical question. I have some ideas, but I haven't put pen and paper to the implication if the state could afford my idea.
All right, let's change gears here and start wrapping up. I have a few rapid fire questions for you. I need to know 3 terms every Michigan homeowner should know.
Taxable value, assessed value, state equalized value.
Perfect. And we've covered all of those.
Correct.
So well done. How often do tax assessors visit properties physically to update their records?
We attempt every 5 years, but you can always tell us we can't come. And then I'm using my GIS aerial maps and Google Earth and whatever else I can do to determine what I think you have.
So when you approach a house, do you knock on the door
Sure
and say,
do.
hey, I'm going to check you out?
We send postcards.
Oh.
We say, we are coming, and if you do not want us on your property, please call.
Okay. Yes, I recall having a postcard sent to me. That
Right?
does sound
Because
right.
if you don't want me there, we don't want to be there.
Amen to that, sister.
Amen. There's lots of craziness.
So you come, you check it out. If you're not allowed to come check it out, pre-Google, what were you doing to assess values when you weren't invited to go?
Well, it's just been in the last 10 years that the State Tax Commission, maybe a little more than that, where they said we had to notify you.
Okay.
So before it was just knock on the door, oops, nobody's here, hang a flyer, your assessor was here, and we would go around your property and do what we had to do.
Ooh. Things changed.
Things change.
Okay, true or false? This is fun. Do tax assessors at any point in time use Zillow?
Yes. True.
In what circumstances do you use sources like that?
That I do?
Or
Personally.
assessors? Yeah.
Okay, if I'm looking at a sale when I'm entering the deeds and the sale is for $150,000 more than what the true cash value I have, I'm going, well, geez, do I have a finished basement? Things, because we're not supposed to look in any windows when we walk around properties. Just observing and finished basements is our nemesis. So I look at that and I look to see if the home's been totally remodeled. So I do. I love my Zillow pictures.
Okay.
And I've complained when, 18 months, I'm going backwards, going, okay, I want to see this house, and they're gone.
Mm-hmm. Oh, yeah. It can happen. What's one habit that every real estate agent should adopt?
Helping their client determine if they can afford the house they're showing them.
It's a good habit. Yeah. An essential and necessary and non-negotiable habit.
Yeah. One myth you want to kill forever.
One myth.
Yeah.
That I don't have any myths. I mean,
No?
it's pretty much we do it by law.
Pretty cut and dry,
It's
huh?
pretty cut and dried. I mean, I can't say I like you. You don't pay any taxes.
Mhm.
Everything is cut and dried. So
Yeah.
we're nice people.
Yeah. You're not the bad guys, right? Like
We are not. We have a
Right.
bad job, but we're not the bad guys. Well, who wants to grow up and be a tax assessor and get yelled at all day long?
It's data. You're collecting data.
Okay, I'm
Yeah.
collecting the data set. Yes, I am.
Yes.
What is one thing you wish more people knew about what tax assessors do?
We really try to do everything fair and equitable. And to do that, we have to have the data points.
Mm-hmm.
And to get the data points, we have to look.
Mm-hmm.
And so we do try to do a good job, but we're 18 months behind my market.
This has been so enlightening. It's been, I mean, honestly, a very educational conversation for us. And I hope also for all of our viewers. Molly, thank you so much for bringing this transparency to something that really impacts and affects affordability and peace of mind for every homeowner. Thank you so much for joining this episode of Recharge. I hope this was helpful for our agents, but honestly, I hope that this message gets out to home buyers as well, because being educated can have such a profound positive impact on your real estate buying experience. So if you found this helpful, please go ahead and share it with an agent or a homeowner that's out there who needs this. We love to share these messages. We love to have these conversations. So thank you so much for your time. Thank you, Molly. Really appreciate it.
Thank you for having me.
Absolutely.